Iron Financial, we don't just build portfolios, we forge them. We take them into the fire of market volatility, apply the pressure of uncertainty, and see what comes out stronger. We don't just look at stocks, we put them through a rigorous stress test. We're here to cut through the noise, to get our hands dirty, and to inspect the core structure of a company to find out if it is truly built to last. I'm your lead analyst.
And today we're putting BJ's Wholesale Club right on the rack. The company just dropped its earnings report, and the market did not like what it saw. The stock got hammered. Now, you know, that kind of weakness is exactly what gets our attention. It's a flare in the sky. But is it a flare signaling a rescue opportunity, or is it signaling a fire we should be running away from? And as always, keeping us honest, our market skeptic is here. He sees a stock taking a nosedive, and he's asking the big question. Is this a buying opportunity, a company with a foundation made of steel that's just on sale, or are we looking at a house of cards just waiting for the next economic breeze to blow it all over? That's the question we're going to answer today. All right, let's not waste any time. The market is a voting machine in the short term, and in the last 24 hours, it has emphatically voted no on BJ's. But here's the thing. Panic sellers, they create opportunities for disciplined investors. So the very first thing we have to do is figure out if this was just a classic knee-jerk overreaction from Wall Street, a bit of a tantrum, or did the market spot a genuine red flag, a deep structural problem that we need to take very, very seriously. So let's get into the initial damage report.
Okay, let's get the tools out and look at the engine block. On the surface, things actually looked pretty good. For its fourth quarter, BJ's posted adjusted earnings per share of 96 cents. Now, Wall Street, they were only expecting 93 cents. And look, in our workshop, a beat is a beat. It's the first piece of solid evidence for the bulls. It tells us that the core engine of the company, its ability to generate profit, is firing on all cylinders. This shows discipline, it shows they can manage their expenses and squeeze out a profit, even when things get tough. For anyone arguing the bull case, this is the first cornerstone of their argument.
Hold on. Don't start celebrating just yet. An earnings speed is just one gear in a very big, very complicated machine. We've got to inspect the whole assembly. The market is always looking forward, not backward, and it saw two massive problems staring it right in the face. First, look at that top line, revenue. It came in at $5.44 billion. The estimate, $5.54 billion. That's a $100 million miss. That's not pocket change. It tells you that, yeah, they're profitable, but they're not bringing in the sales they were supposed to. The sales machine is clearly sputtering. And even worse, you look ahead and you see that weak guidance. That's the real issue. That's the crack in the facade that has everyone spooked. And this, right here, is the immediate, quantifiable result of that conflict, the battle between a solid bottom line and a shaky top line in future. A 4.5% drop in the stock price. The market put the good news on one side of the scale, the bad news on the other, and decided the bad news was a whole lot heavier. Here at Iron Financial, we don't just see a negative number, we see a stress event. This is the moment. This is when the pressure gets applied, and we get to see what a company is truly made of.
So, before we can even think about issuing a verdict, we have to do our due diligence. We have to be engineers here. And any good engineer knows you start by inspecting the foundation of the structure. Is it solid? Is it sitting on bedrock? Can it bear the weight that's about to be put on it? We need to tune out the noise of a one-day stock drop and analyze the core load-bearing components of BJ's business model. Let's start by laying out the bull case, piece by piece.
Now, what I want you to focus on with this chart is the sheer, relentless consistency. This isn't just a number. This is a load-bearing metric. For 16 straight quarters, that's 4 full years, through a pandemic, through inflation, through everything, more people have physically walked into their clubs than the year before. This is not a fluke, it's not a short-term bump, it is a sustained, powerful trend. In a retail world where consumer loyalty is paper-thin, this shows that BJ's has built something that people want to come back to again and again. This is the bedrock. You can have the best stuff in the world, but if people aren't showing up, who cares? BJ's knows how to get people in the door. In this table right here, this is the blueprint that explains why they keep showing up. This is the steel frame of the entire building, the membership model. Look at that first line, membership fee income. That's the good stuff. That is pure, high-margin recurring revenue, and it was up almost 11% year over year. They hit a record number of members. Now look down to the renewal rate, 90%. That is the number that matters. 9 out of 10 long-term members are saying, yes, take my money again, it's worth it. That creates a powerful moat around the business. It's sticky. And don't think there's some old-school dinosaur. Look at digital sales, up 31% in the quarter. That's a 57% growth rate when you stack it over 2 years. They are adapting, they are thriving.
Okay, so the business model looks solid, but what about the financial integrity? What about the nuts and bolts? This is where we apply our first real stress test, the Altman Z-score. Think of it as a financial health checkup designed to predict the probability of a company going bankrupt. It looks at everything: profitability, leverage, liquidity, solvency. A score below 1.8 is a major red flag. A score above 2.99 is considered safe. BJ's Wholesale Club scores a 4.92. That isn't just safe, that is rock solid. This tells us in no uncertain terms that whatever short-term headwinds they're facing, the underlying financial structure of this company is incredibly stable. There is practically zero imminent risk of collapse here.
But you know us, at Iron Financial, we don't just rely on a single test. We're not just going to tap the wall and say it's good. We layer our analysis. So next, we apply another test, the Piotrowski F-score. This is another financial checkup, a 9-point scale that measures the strength of a company's financial position by looking at its profitability, its funding, and its operating efficiency. A score of 7, 8, or 9, that's the gold standard. That means you have a very healthy company. BJ's scores a 7. So now we have two independent, rigorous, time-tested financial models, and both of them are flashing bright green. The foundation isn't just stable, it's robust. The internal mechanics of this company are absolutely sound.
And of course, management is right there, standing firmly on that foundation. The CEO, Bob Eddy, said it himself. He points to the strength of our transformation and disciplined execution. Look, this isn't a management team that's panicking. They're projecting absolute confidence. So let's just recap the bull case. You've got a relentlessly growing customer base, a powerful and incredibly sticky membership model, and two key financial health scores that basically scream fortress balance sheet. From this perspective, this structure looks like it was built to withstand a hurricane.
Okay, that is a compelling case. I'll give you that. A solid foundation is absolutely critical. But even the most well-built skyscraper can have vulnerabilities. No structure is perfect. So now it's time to put on a different hard hat and start looking for the stress fractures. It's time to examine the bear case with that same intensity. What are the potential weak points? What are the cracks that could bring this whole thing down if the pressure keeps building?
And this is where the narrative really starts to split in two. The bulls, they'll point to that long-term trend, and they're not wrong. An average 3-year revenue growth of 8.3% is impressive. But what are we as investors really buying? We're buying the future, not the past. And when you zoom in on just the last 12 months, the data clearly flags a slowdown. The rate of growth is decelerating. It's losing momentum. So the big question becomes, was the incredible growth of the last 3 years the anomaly? And is this slowdown the new normal? Because if there's one thing the market hates more than anything, it's deceleration.
And right here, this is where we find what I believe are the most significant cracks in the entire foundation. Let's get into the plumbing of the balance sheet. First, debt to equity is 1.24. Okay, that's a moderate amount of leverage, nothing too crazy. But then you look at the current ratio, 0.79. A healthy company is typically above 1. This number whispers that BJ's might not have enough liquid cash and assets to cover its short-term bills. Now look at the quick ratio. It's a brutal 0.16. This ratio is tougher because it removes inventory from the calculation. A number this low tells us that without selling the stuff on its shelves, the company would be in a very, very tight spot. It is almost completely reliant on moving product to pay its bills. In a strong economy, maybe that's fine. But what if a recession hits? What if the consumer pulls back? That isn't just a crack. That is a potential fault line running right through the heart of the company.
And then there's this. Insiders, the executives, the directors, the people who know the company better than anyone, they've sold over 15,000 shares in the past few months. Now, we always say insiders sell for lots of reasons, college tuition, a new house, but they usually only buy for one reason. They think the stock is going up. Still, when you put this selling pressure right next to slowing top-line growth and those really worrying liquidity ratios, it just adds another layer of caution to the blueprint. It forces you to ask the question, are they seeing the same cracks that we are?
Those are serious points. That liquidity situation is a genuine concern, and you can't just ignore the insider selling. But the one item that truly sent a shockwave through the market, the absolute epicenter of the sell-off, was the forecast. The biggest test for any structure isn't what it has held up in the past, it's the pressure from future expectations. So it's time to run this company through the guidance gauntlet.
Okay, let's really break this table down, because for the bears, this is the smoking gun. For the next fiscal year, BJ's management said they expect adjusted earnings per share in a range of $4.40 to $4.60. The problem? Wall Street was expecting $4.66. Even at the absolute top end of their own forecast, they are signaling that they will likely miss the consensus estimate. That is a direct warning to investors to lower their expectations. And it gets worse. Look at comparable sales growth. They're guiding for 2 to 3%. Now sure, that's still growth, which is better than nothing. But it confirms that story of deceleration. The days of explosive, high single-digit growth might be over. This guidance is the #1 reason that stock got absolutely punished.
And so this is it. This is the central conflict. This is the one question every single person looking at this stock has to wrestle with. Is management just being incredibly conservative here? Are they just setting a really low bar that they know they can easily hop over later in the year? You know, the classic under-promise and over-deliver game? Or is this a genuine alarm bell? Are they seeing storm clouds on the economic horizon that we can't see yet? Weakening consumer demand? Pressures on their margins? Are they trying to warn Wall Street that tougher times are coming? The answer to that single question determines whether this stock is a bargain or a trap.
All right, we've laid out all the evidence, we've gone through the blueprints, we've examined the strong foundation of the bull case, the power of that membership, the steady traffic, those rock-solid financial scores, and we've also highlighted the very real cracks of the bear case, the revenue miss, the tight liquidity, and that all-important, ominous, weak guidance. We've run the stress test. Now it is time to weigh it all and issue the official Iron Financial Engineering Report.
So here it is, the final weigh-in, side by side. In one pan of the scales, we're placing the foundation. That's the fortress of its membership model, the proven financial stability from the Z and F scores, and the undeniable, consistent draw of its customer traffic and digital growth. This is the steel. In the other pan, we place the pressure, the undeniable reality of a revenue miss, the clear slowdown in growth, the tangible risk hiding in those liquidity ratios, and the massive dark cloud of that weak forward guidance. This is the heavy load being placed on that steel.
So if you're holding this stock, or if you're thinking about it, what are the critical data points you need to be watching from here on out? Here's your checklist. First, keep your eyes glued to that membership fee income number. If that growth starts to slow, the entire bull thesis is compromised. Second, track those comparable sales every quarter. Are they hitting the low end or the high end of that 2 to 3% guidance? That tells you if they're struggling or if they're executing well. Third, watch the margins. Are they getting squeezed? And finally, and maybe most importantly, you have to monitor those inventory levels and liquidity ratios. If that quick ratio gets any worse, it is a massive red flag that the financial pressure is intensifying.
After weighing all the evidence, after running all the tests, our verdict is this. The company itself is structurally sound. The core business, the brand loyalty, the financial stability, it's absolutely there. The foundation is solid, but it is undeniably facing a heavy load. The pressure from a slowing economy and the weight of its own weak guidance are immense. The market is not crazy, it is right to be cautious here. For us at Iron Financial, that makes BJ's Wholesale Club a hold for now. The foundation is far too strong to justify panic selling into this weakness. But the headwinds are far too significant to recommend buying until we see how the structure really handles the pressure. The risk and reward are just too balanced right now.
And that leaves us with the final forward-looking question, because this is now a story about execution. It's on management. Can Bob Eddy and his team navigate this incredibly challenging environment? Can they manage their inventory better to improve those scary liquidity ratios? Can they continue to deliver the value that keeps members renewing and traffic growing, even when wallets are getting pinched? In short, can they execute well enough to lighten this heavy load before the pressure creates any more visible cracks in the structure? That is the heavy lifting they have to do. Starting right now, keep this one on your watch list. The next couple of quarters are going to tell the real story. And for more deep dive stress tests just like this one, make sure you're subscribed to Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.